Hello, it is me again. I am back with another informational video. Again, my name is Terrace Partee. I am not a financial advisor. However, I have been trading these markets for over 10 years, and I have learned quite a bit in my 10 years of trading. But I also want to share what I've learned. So that's what this video is about. I'm going to set my timer because I want this video to be no more than 30 minutes. So if I know we have TikTok um, attention span, so I'm going to start with the timer now. And let's go ahead on and get started with this options class. Now, many of you have reached out to me wanting to know about options. This is just a basic class. You can purchase the class on my website, and I'll give you that website at the end of this course, but you can purchase the full in-depth class. This is just like a refresher or a starter course. So let's talk about it. What is options? Options is a financial strategy that involves buying and selling options contract. Now, of course, I'm not going to just sit here and read slides to you. I'm going to be explaining to you each one of these slides as we go by. And let's see, we got 15 slides. So we're going to try to do this in a timely manner. All right. So when we're trading option, it gives us the right, but not the obligation to buy or sell an underlying asset at a predetermined price before or on a specific expiration date. So basically what it's saying is you don't have to buy 100 shares of a stock, or you don't have to buy the stock that you are trading that option contract on. So the underlying asset is going to be just simply the stock or the ETF that you're trading, that you're buying the contract on. The predetermined price is going to be your strike price. So we'll talk about that a little later on. And a specific expiration date is going to just be the day that your contract expires. All right, so let's talk about the different types of options. You have a call option and a put option. A call option is when you believe the price is going up. Now, when I wrote this program to be like dummy down, or like a third grader can get it. So a put, so it's not going to be technical terms. I'm trying to break it down as clear as possible. A put is when you think the price is going down. So you're going to buy either or. So if I believe that the price of an asset is going to go up, I'm going to buy a call contract. If I feel like the price of an asset is going to go down, I'm going to buy a put contract. Okay, it can kind of be counterintuitive because when you say buy, you typically think that the price is going to go up. But keep in mind, you're buying contracts. All right. So, and same thing here. I just repeated exactly what I just said earlier. All right. So, how do we choose a strike price? So, we got we have our asset that we're going to choose. We like Apple. I'm going to choose Apple. That's why I got this Apple over here. But we don't know what strike price to get. I think the price is going to go up. So, I want to buy a call. This is the way I choose my strike price. Now, you may find that other traders or other teachers will tell you, no, you choose a strike price this way, but this is the way I choose my strike price. First of all, I always choose my strike price in or at the money. Now, I know you don't know what that means. We're going to talk about that next. But suppose if you buy the $100 call and the price of Apple is trading at $101, okay? You're going to choose the strike price of $100, because it is the support level. So that's my secret. I trade whatever that support level or resistance level is. That's what I want my strike price to be. So notice I'm going to be under the price if I'm choosing a call, but I'm going to be over the price if I'm choosing a put. And I'll show you what that looks like later on. So you don't have to worry about nothing. Okay. You can choose to cash out on the contract or buy 100 shares for $100. And that's what we were saying earlier about you don't have the obligation. You're not obligated to buy 100 shares because when you buy an options contract, you're essentially, it's like you're buying 100 shares of that particular asset. So when you look at an option chain, it might have $1, that the contract is $1. Well, you're gonna multiply that dollar by 100 because it's like you're buying 100 shares of a particular stock. Okay. All right, let's talk about in the money, out of the money, and at the money. That's what ITM, OTM, ATM stands for. All right, Apple is currently trading at $100. So we're buying calls, right? So in the money is going to be less than $100 because you are in the money. You're trading below where the price is currently trading at. At the money is going to be right at $100 because it's trading at $100. Out of the money is going to be greater than $100 because you're trading outside of the money, outside of the price that is currently traded, that is currently trading at. Okay. So that's what that means. That's what those terms mean. When you hear somebody say about an in the money contract or out of the money contract, now you know what it means. So Apple is currently trading at $100. I'm looking to buy puts now. So when I'm buying in the money puts, I'm going to be above 100. This is what I was talking about. When you're buying the puts, the in the money is going to be above the $100 trading price. At the money is going to be $100. And notice I have more costly, average cost, less costly. Out of the money is going to be below 100. Okay, so when you get to your options change, you'll understand it a little bit better. I'll show it to you when we go to the options block. Now, when you're buying in the money, it does cost a little bit more. Okay, so you're going to spend a little bit more money on those contracts. You're also going to spend a lot more money depending on the expiration date. So if I got a contract that expires today or tomorrow, it's not going to be as expensive as a contract that expires a month from now, or a year from now, or 2 years from now. The further out you go with your contracts, the more expensive it's going to be, whether you get in the money, out of the money, or at the money. Okay, y'all following me so far? All right, let's look at the expiration date because these are all components of your contract. Your expiration date can range from 1 day to 2 years. Most of you are day traders, so you probably just get nothing no more than 30 days, if that long. I just explained that the further out the date, the higher the contract. The closer to expiration, the cheaper the contract. Choose an expiration date that suits the strategy you're using, okay? Let's go over that. For example, if you can choose a 1 day expiration, and those are usually on stocks like all the contracts are going to expire on Fridays. Okay, so let's say you get in a trade, options trade on Friday, and you just want to day trade it. Okay, choose the 1 day expiration. Choose the expiration that expires on that Friday. SPY, SPY, QQQ, stocks like those are ETFs. They can be traded every day. Like they have a daily expiration. So you can trade those every day, or if you have a cash account, or you can trade it 3 times a week. Okay, and I explain why I say a cash account in a few minutes. All right. You know what? I don't, yeah, I do. Okay. 2 to 7 days if you're swing trading. So if you're swing trading, you think you're gonna hold it all week, then you can choose, or even if you're day trading and you say, I don't really know what the price is gonna do, but I don't want theta to eat up my contract. And I explain to you what theta means in a couple of more slides. Then you might want to get a 2-day contract just so you can hold it a little bit long, give it more room. And then 1 month and beyond for long terms. So if Apple hit a low and you feel like you want to hold Apple for a year or 2 years, that's when you're going to buy those leaps. Those are long-term contracts. They call them leaps. You can look that up, LEAPS. I can't think of what the leaps stand for, but for the purpose of this video, just know that it's a long-term video. It's generally 1 year or more. Now they're going to be more expensive, but they are a little bit safer because you got more time for the price to fluctuate and do whatever it needs to do. Okay. All right. Now let's stop. Number one, if you have less than $25,000 in your account, you can only make 3 trades in and out within a 5-day period. What do I mean by in and out? That means open and closing that trade. That's what in and out means. So if you do that within a 5-day period, you can only do 3 if you have less than $25. However, you can have a cash account, which means you're not asking the brokers to give you margin. You have a cash account, you say, hey, I'm going to put my own cash in here. I'm going to put $500 in here and I'm going to just trade it. But it really pans out to be three trades in a week anyway, because the money has to clear the brokerage first. And it usually take about a day before that trade can clear. And you can't use that money. So if you win $100, or let's say you win $500, well, you can't use that $500 to get into another trade until that clears. So just keep those things in mind. All right, let's talk about a premium. The premium is just nothing but the cost of the contract. And you're going to multiply that by 100. This is what I was talking about. So you're going to see on the option chain $1.25. You multiply that by 100, it's going to be $125. So that's how much your contract is going to cost. And that's the most you can lose on that contract. Okay? You can only lose the amount you paid for the contract. Let's talk about Greeks, because I mentioned something about theta earlier. This is how your contracts make money. This is how your contract, this is how you can tell how much you're going to make on your trades. So I'm only going to talk about 2 Greeks. I'm going to go briefly over the other Greeks. You can look those up on your own time, but personally, I never really had to pay attention to them. I just haven't. I can make a reasonable trade just knowing the delta and the theta. Okay, so your delta measures how much the price of a contract will change for every $1 that it moves in price. So when you look on your contract, you're going to see the delta is going to be like 0.5. If it's a put, it's going to be a negative number. So basically it's saying that for every dollar that the stock go up or down, you're going to make or lose $50. Okay, simple enough, right? Theta measures how much it costs for you to be in that contract every day. So you think about, if you get a daily contract, you get a contract that expires on the day, you need that price to move and move pretty fast, because if it doesn't, that theta is going to ramp up really fast and it's going to eat your contract up, and your contract is going to be worthless if you don't hurry up, and if the price doesn't hurry up and make a move. This is why when you're getting those 1-day contracts or 0 date to expiration, you want to get a stock that's moving.
Like you want to get a mover like Tesla, Nvidia. You want to Google, not Google, but Facebook. Facebook is now Meta. Um, what's another? Netflix. You want stocks that make at least a $5 to $10 move in a day. You don't want no slow stock. You don't want a stock that just drag. Okay. So this increases rapidly the closer you are to your expiration date. This is why I say when you get those 1 to 2 year contracts, your theta is like really slow. It's only like maybe $1 a day. It's not a whole lot of money at all that you are expending on that contract. But you're making money because of the length of that contract. All right. I like to get long-term contracts on my ETFs like QQQ, SPY, because they generally are set up to go up, period. So you just wait until the market pulls back to and I'm talking about a really good pullback. The market usually pulls back around October, and then again in February going into March. You usually will have a really good pullback, and that's when I like to buy my contracts for the long term. Okay. So the longer the expiration date, the lower the theta, and the shorter the expiration date, the higher the theta. Here are your other Greeks. You can Google those. They usually affect the delta or tell you about, like sometimes when a stock is oversold or overbought, you can look at your Vega, all those, you look those things up if you're interested in that. All right, let's put it all together. I think I'm doing good. I think I'm doing good. Y'all got 13 minutes. And we still got to look at the charts. So let's put it all together. You're going to choose an underlying asset. You're going to look at the chart and the news because you want to make sure that whatever stock you're trading, you don't have some type of crazy announcement that's going to, make the stock you. But if you like taking that risk, then be my guest. I personally do not like to trade when there is like news going on with a stock. But some people use that as momentum. So you're gonna look at the stock. Look at the chart, see where you're at on it. Are we on support or are we on resistance? And then you're gonna see if there's news affecting that's gonna affect that price. Okay. Then you're gonna decide on whether you're gonna get a call or a put. Then you're gonna choose a strike price and an expiration date. You're gonna exit at the next level of support or resistance. It's just that simple. All right, here's my info. You can see my email down here is paychip. I'm sorry, I say paychip. I always say paychip. Payhip.com/maglight trading and education. All right, so if you want a one-on-one coaching, I do those. Self-paced course, that's going to be the options course that I was telling you about. It's self-paced, you can take it. I got it chopped up, so it's like bite-sized information. I have a live futures class that students can come to 3 times a week and learn how to trade futures live. And then I have several books on my website. All right, let's go to the chart. Let's go to the chart. I personally like Robinhood. Now that's just me. I like Robinhood, so don't judge me. You're gonna hear a lot of bad things, but they can say what they want. Robinhood has the most easiest platform to use, so I like it. Ooh, Apple has gone up $8.96 today. All right. So first thing I want to do is I want to go to the chart. So I can go to advanced on Apple, and let's make that candlesticks. All right. I actually saw Apple. I was looking at Apple about over the weekend because I want to make this video over the weekend. And I said, oh, Apple is coming down on support. Let me see if I can get me a call. And I have waited too late. All right. Let's do the 1 year. So we want to look at the daily time frame so that you can just see where you are on the overall point in this maze, okay? Now, if you watch my previous video on support or resistance, then you know you look to the left to see the historical data of support and resistance, okay? Now, I did have my TD Ameritrade pulled up because I don't really be on here as far as the charts. Let's see if I can, I want to add some line, but I don't see how I can do it. Uh, all right, let's see. All right, follow my crosshairs. On the right, this far right candle, this is where we are today. You can also look at the bottom of the chart and scroll over and it'll tell you this is where we are trading this at this point in time. So I looked over here to the left and I saw support here. I said, oh, wait a minute, there's support at between 219 and 220. So when the price comes back down there, then what am I going to do? I can get a $220 call. I can get a 219 call. It doesn't matter. I got a nice little green candle there. That's my signal that tells me I can get into this trade. I even have a hammer here that tells me I can get into this trade to the upside. Now, where is my resistance? I notice I have a gap right here. So the market could get some resistance there. So if I got in from 220 all the way and rolled it all the way up to 228, that's a nice piece of trade. 8 days. And I only had to be in that trade a couple of days. Okay. So let's say this was January the 22nd and we decided to get into this trade. We decided we were going to get a 220 call because the price is, that was the support level. So I'm going to trade Apple options. And I'm going to choose, we're going to pretend that we are at our other, we were at the other day. Let's pretend that this was 2 days ago or Friday. We're going to choose the January 31st because we believe that the price is going to move up the next day or the next couple of days. So I'm going to buy a call. Notice I have those two greened out. If I were to buy a put, I would just simply change that to buy put. Okay. So I'm going to buy a call. And over here, you see my strike prices. I'm going to find the 220 strike price. Don't worry about break even percent. Don't worry about none of that. You can see over here, it is $19.30. Now, I can click on here and I can see the Greeks. I've got a 0.91 delta, which means I'm going to get $91 for every dollar that it moves in my favor or lose $91 for every dollar that it moves against me. Look at the previous close on this one. So if you got in this yesterday and paid $11.90, which is $1,190, look at how much this contract has increased since yesterday, $9. So that's $900 that approximately you could have made on this trade, $800. You could have made in one day based on how much you paid for it on yesterday. And then the theta is 0.40, which means basically it's costing you $40 a day to be in this trade. However, you'd made $800. So, you pay, and you don't really see it. You'll see, only thing you're going to see in your options contract is the amount that you made. So it's not like you're seeing money just disappear. Okay. So then I'm going to click on this plus sign, and over here it's telling me my total cost. I'm going to continue is, remember what we said, $19.45 times 100 is going to be $19.40. Now, I like the bid and the ask. The bid tells you the lowest amount so you can pay to get out of that trade, and the ask tells you the amount you have to pay to get into that trade immediately. Robinhood likes to give you a middle price, and so they tell you it's a medium fill likelihood. But watch what happens if I put $19.50 in there. It says a high fill likelihood. So you can just kind of negotiate that price however you see fit. If I want to get in and I'm just gonna pay the X price, I will. A lot of times it will take it though right there in the middle. So if I paid 1940 for this contract and I said, you know what, I don't think I want to be at Apple anymore. Let me get out of this contract. Then I'm going to lose money because the bid is $19.35. So I'm only going to be, somebody is only willing to pay me $19.35. So I'm going to lose $5 on that contract. Okay? You can come down here. Look, they have a little scale to tell you, you know, what happens to your money if your price goes this far. Notice I said you could only lose the amount you pay for the contract. So as the price pulls back, this is how much money you're going to be losing. If it goes forward, then this is the amount your winnings or your profits is unlimited. So you can, as long as it's going up, you can make money on this contract. You're going to review the order, put in the amount of contracts you want. So just keep in mind, it's 100 shares each. So if you do 2 contracts, then it's going to be, let's see how much it's going to be. It's going to be 1940 times 2, however much, 3800, 3880. And then you'll be buying 200 contracts. And you want to do good for today. They're telling me to deposit funds. This is my small account. I don't really keep a whole lot of money in this account. But anyway, it's going to tell you to submit, and then voila, there you go. And then it will show up on the top of your screen, and then you'll be in the trade. I'm going to try to do one on, what did I do? Trade QQQ options. Now, notice you'll see a lot of them that like really cheap because remember I told you QQQ and SPY have everyday expiry. So you get one every day. So the higher, remember, if we're doing a call, here's the price, this is the current price. If I'm doing a call, I want to be underneath the current price, share price. This 521 is going to be at the money. Anything below that is going to be in the money. Anything outside of the money is 521. Anything outside of that is going to be cheaper and is really probably going to be worthless. So if I were to buy this contract for $5, I continue. See, they're even expecting me to have a loss on that one. Because even if the price goes up, it have to go up to 525 in order for me to break even because of the theta and all that other jazz. Looking at my delta is $5, my theta $5. So I'm not really gonna make any money on that contract. So you're gonna review that order. Review the order. It's telling me I got a day trading warning. It's gonna tell you over the past 5 days, you have not made any trades. So you made 1 day trade in your individual account. If you make 4-day trades within 5 days, so it's really 3. So when you make that 4th trade, that's when they're gonna flag you. Okay. And then I just hit continue, and then I will be in that trade. I'm not gonna take that trade because it is lousy. All right. And that's basically it. That is it in a nutshell. If you go to any option chains, it's pretty much gonna look like this. However, if you want more in-depth teaching, you want more understanding of the charts, check out my video on that. I placed it on YouTube the other day, or you can schedule a one-to-one with me, and I will be more than happy to break down and go over anything you like. I did this in 30 minutes. Yes, I'm so excited, and I will catch y'all on the next video. Post your comments in the questions if you want, and I'll try to answer all of them that I can. And of course, like and subscribe. I need some more subscribers. I need some more likes on my video. So if this information has been helpful to you, like and subscribe. It don't take nothing to hit that button. Just go and hit it. Okay. All right. Y'all have a great day. Bye bye.